of the fastest growing companies are the first ones to get declined for financing. And it's not because they are failing, it's not because they are unprofitable, it's because they're unpredictable. Revenue is the most celebrated number in business, but to a bank, it's rarely the most impressive one. And this video and this conversation isn't about borrowing money, it's about structure. Because if your business wouldn't qualify for credit today, even if you never plan to apply, that tells you something important about how it's built. Is it built for momentum or is it built to endure?
What happens is when banks evaluate your company, they are not asking how exciting the business is. They're asking how stable is this business under pressure. They look for things like predictable cash flows, consistent margins, manageable leverage, or let's say healthy coverage ratios.
What does that mean? Healthy coverage ratios.
So one of those would be a debt service coverage ratio. So we define many lenders want to see cash flows covering the debt obligations at least 1.25 times. That's not about ambition, but that's about the discipline of that business or the business owner. Predictability reduces risk, and risk is the only thing financial institutions are trained to manage. But predictability does something else as well. It creates confidence, it strengthens negotiation power, it strengthens the valuation of that business, it strengthens how investors see that business. Growth attracts attention, but predictability earns their trust. There's a difference. Growth and predictability, they are part of the business, but there's a difference on how each thing empowers the business. The trust compounds year after year. Profitability allows you to sleep better at night. It allows you business to withstand pressure without feeling fragile at times.
Hmm.
It gives your company strong legs, the kind that endure downturns, market shifts, and unexpected storms, as you would say.
Some of the